Okay, we can start with the class. They'll find us on the way. Right, we are going to look at this question. I think I posted in the group on test for last year. I think this is the structure of our test 4, which means in our test 4, we are going to have more on capital budgeting and business valuation and ratios. Those are the main topics for test 4. So let's look at this question we want to do the question for capital budgeting. Let me just check the questions. So which means we're going to do the question for capital budgeting. That is B. We can start with B because B is the long one. A and C are also part of capital budgeting, but they are short questions. So let's start with B. So in our B, they say using relevant investment appraisal methods, determine whether Bidvest company should invest in Zolabad project with reference to the minimum investment criteria. So this is what we are going to look at. Right, so let's go to the story and see what they are saying. So they say Bidvest company is a South African multinational corporation listed on the Johannesburg Stock Exchange with a market capitalization of 200 billion as at 31 August financial year end. The company is a holding entity which invests in unique business ventures across the country and has a strong presence in different regions across Africa. The company has interest in financial service, mining, logistics, clothing, personal care, beverages, and food products. Bidvest has different ownership structure in its related entities, including wholly and partly owned subsidiaries, joint ventures, once-off or limited lifespan projects, significant or minority shareholding, agents, and franchising. The company's head office are in Kempton Park, South Africa, where the investment board, which is responsible for all the investment decisions of the company, is based. The investment board set out different minimum investment criteria which need to be met before investing in a new capital project. Or in a target company. Right? For capital projects, the requirement is that the project should yield a minimum profitability index of 1.05 and have a payback, and the payback must be discounted. Let me just admit the other guys here. Right, so the payback must be discounted. That is not longer than 5 years. The company may undertake as many capital projects as possible if funds permit, but where the company can only choose one of the given alternatives, because initiative on the different project can not coexist, then the one that yield the shortest payback will be chosen, provided that the minimum investment criteria are still met. So here we have here, this is the minimum requirement for choosing a capital project. They must yield a minimum profitability index of 1.05 and have a payback period that is not longer than 5 years. So those are the minimum requirements for the project to be accepted. So when you are answering your question there, you must also take note of that part. Right, then for the question requires us to do the solar bad project. So there is no need for you to read everything because the question requires you to do the solar bad project. So which means we should now focus on the solar bad project, which is the question that we have, the information that we need for the question. So let's look what they say about the solar bad capital project. While the negotiations with the GBS team were underway, the investment board embarked on a breakaway strategy session where it wanted to consider an alternative capital project, the solar bad, as a different way of entering the highly competitive passenger transportation industry. The session was facilitated by Stratatex consultants, who are the market leaders in tax industry research. They also have a strong affiliation with the different tax associations across the country. They've just submitted an invoice of 26 million for the strategy session they hosted, which is already due. So there is an invoice of 26 million for the strategy session. Subsequent to the strategy session, the investment board has established the following. As an alternative to GBS, Bytevest can purchase a fleet of brand new minibuses from Toyota Commercial Limited with a budget of 230 million payable upfront in full. Each minibus is diesel fueled, carries up to 9 passengers and cost 1,150,000. That's the cost of each minibus. For the next 5 years, these minibuses will be used for long-distance passenger transportation as they offer great comfort to travelers. At the end of the 5-year period, these minibuses will be sold at 150 each. Right, so this is going to be the residual value they can receive at the end of the 5-year period. Each minibus comes with a free 3-year 180 kilometers maintenance plan worth 60,000. Then Bytevest will have its fleet service for free for the next 3 years or up until the minibus has reached 180 kilometers, whichever occurs first. Bytevest will extend the maintenance plan upon expiry on the same terms and cost. The extended maintenance plan is paid upon expiry of the original maintenance plan. So you can see this maintenance plan is free for 3 years. Then from the 4th year, then they will have to pay for this maintenance plan. Right? Then they say passengers using minibuses need to book their bus ticket in advance, anything from a day before the trip up to 60 days. The bookings will be done on Bytevest company's existing website or via an app that will be developed and launched at the start of the project at a cost of You can also look at this one. This is the cost of the app which they are going to use. So it's part of the capital expenditure. Alteration to the website will be made by one of the head office full-time IT specialist who is on a fixed annual salary of 740. Then an external IT consulting company would get paid a once-off 140,000 for similar work. So here there is going to be the guy who is going to be responsible for the alterations is a fixed employee who is earning 740. So this amount is not going to be part of our cost because already it's not relevant. Remember, we say when you are answering capital budgeting questions, you must also take into account relevant cost. Right, then once-off graphics, copyright administrations, and other website-related costs. So these are the costs for the project. Then there is also upfront permit registration for the tax association. So this is going to be also another cost for the project. Then on average, each minibus will generate about 1.02 million annually in revenue, and the revenue is expected to remain constant until the end of year 3. So which means it will be 1.02 million for year 1 until 3, then revenue will increase by 4.9% in year 4 and remain at that level for the foreseeable future. Minibus drivers will be paid an annual salary of 250,000 each, which also includes accommodation and out-of-town costs they might incur. The minibus drivers will be on a fixed 5-year term contract, and each driver will be assigned to his or her own minibus for the duration of the contract. So this is also the cost of running the project, the minibus salaries, minibus driver salaries. Right, so let's go to the next paragraph. They say each minibus is expected to travel 50,000 kilometers per annum. The fuel consumption of each minibus is 8.5 liters per 100 kilometers. And this is not expected to change for the life of the minibus. Right? There's already has fuel storage tanks in major depots across the country for the refilling of its logistic business fleet. Fuel is usually kept at sufficient level. So this is going to be another cost, the fuel cost. So they say fuel is usually kept at sufficient levels, and therefore, for the next 5 years, the minibuses will also make use of these depots to refill. Diesel is currently sold at an average price of 22 Rand 20 per liter throughout the country. However, Big Fist buys its diesel at 20 Rand per liter. So this is the cost they are going to incur for per liter. These prices are forecasted to remain the same for the next 5 years. Other operating costs, insurance, repairs, and maintenance, road traffic are estimated to be 20% of gross revenue. So these are the other operating costs, which means they are going to be the cost of operating the project. Then they say, assume the South African Revenue Service will allow a wear and tear of 6 years on brand new minibuses. For tax purposes, assume all income and expenses are fully taxable and deductible in the same period the income is received or the expense is paid unless stated otherwise. Ignore working capital investment unless specifically addressed. So this is the one that we want to look at, the solar BAT capital project. So the first thing, like what we have discussed in our previous class, what you look at when you are doing a capital budgeting is to look at all the capital expenditure for the project. Then you need also to look at the revenue for the project in your scenario. Then you look at the cost of the project. Then you also need to take into account taxation. So once you look for this, then it means there is nothing that is going to stop you from getting accurate answer. So the first thing is for you to look for the capital. After you are done with your capital, you look at the revenue. Then you also look at the cost. Then after the cost, then you have your net cash flow before tax. Then you can apply your taxation. Then you can now have your net cash flow after tax. Those net cash flow after tax are the one that you are going to discount using the discounting factor, that is the WACC. Then when you discount, then it means your last thing now is to calculate the net present value. Remember, our net present value is going to be the cost of the project, is going to be the present value of cash flow minus the cost of the project. Then you will be done with answering the question. So irregardless of how long the scenario is, you must be able to extract what you want from that scenario, which means us, what we want from the scenario is the capital, the revenue, the cost, the WACC, and then we use them to calculate our taxation and our net present value. So let's quickly go and see how do we answer the question. Right, so we are going to answer B. Let's see how do we quickly answer B. So we are going to calculate the net present value of so you have year 1 to 5. So we're going to have year 1, year 0. Right, so the first thing that we need is to identify our capital expenditure from the question. That's the first thing that we need. We need to identify the capital expenditure from the question. So let's look from the first part of the paragraph. We have, they have submitted an invoice for 26 million for the strategy session. They hosted, which is already due. Subsequent to the strategy session, the investment board has established the following. So what are we going to do with them? 26 million. What is this 26 million going to be? This consultation fee? Are we all there? Did you guys check this question before the class? What is this 26 million going to be?
It's a sunk cost.
Yeah, because it has already been made, so there is no, it is not relevant to this project evaluation. So that one is going to be a sunk cost. Then let's look at the second one. We have they've purchased a fleet of brand new minibuses from Toyota with a budget of 230 million. So this one is going to be a capital expenditure. Am I right?
Yes.
So here we have a sunk cost and capital expenditure. Then let's go again. There is also here, they say at the end of the 5-year period, these minibuses will be sold at 150. So let's do this, okay? So which means in our answer, we have the sunk cost consultation fee. Let me try to, we have the consultation fee. So this one is a sunk cost. Then we have bus purchase. Right, this one is 230 million. So this one is not gonna have any figure there. Then let's go again and look at what else do we need. So we have, we are here. So we are now here. Each minibus, they say this minibus will be used for long distance passenger transportation as they offer great comfort to travelers. At the end of the 5-year period, this minibus will be sold for 150,000. What are we going to call this 150,000?
That's the sale of the bus after
Sorry?
5 years. The sale of the bus after 5 years.
Yeah, that is going to be the residual value after 5 years. Ne? So which means we should have in our answer the residual value of the buses. The residual value is income. So this is going to be after 5 years, which means we enter it at the column for 5 years. Right, then what else do we need from the question? We're at the residual value, let's see. Then they say each minibus comes with a free 3-year maintenance plan worth 60,000. Right, Vest will have its fleet sales for free for the next 3 years or up until the minibus has reached 180, whichever occurs first. Right, Vest will extend the maintenance plan upon expiry on the same terms and cost. So this maintenance plan, the first 3 years are going to be free. Am I right?
Yes, you are right.
The first 3 years are going to be free. Then after 3 years now, that's when we can now they say which occurs first. First will extend the maintenance plan upon expiry on the same terms and cost. The extended maintenance plan is paid upon expiry of the original maintenance plan. Right, so which means here, this maintenance plan is 60. So which means after 3 years, then we need to renew the maintenance plan. So let's come here and say maintenance plan. Right, let's look for any other. So the next thing after the maintenance plan is going to be here, this paragraph, they say passengers using minibus need to book their bus ticket in advance, anything from a day before the trip up to 60 days. The bookings will be done on by this company's existing website via an app that will be developed and launched at the start of the project at a cost of 4,600,000. So this 4,600,000 is going to be what? Is it capital expenditure or revenue expenditure? The app development, is it
Capital expenditure.
Yeah, the app development is also part of the capital expenditure. So we have app development of 4,600,000. So this is going to be capital expenditure, right? So let's continue and see anything else that we need. So this is how you answer your question. These things are not even complicated, Mike. What is important is to know what do you want from the scenario. Then they go on and say alterations to the website will be made by one of the head office full-time IT specialist who is on a fixed annual salary of 740. An external IT consulting company would get paid a once-off 140,000 for similar work. What are we going to do with this 740? Anyone with an idea? What is happening with this? Is it part of the expenses for the project?
It's a committed cost.
Yeah, it's not, it's committed cost. We have this guy who is working on full time. So whether we continue with the project or not, it means this guy is full time already. So there is no need for us to include it in our calculation for deciding whether we continue with the project or not. Then they also say once-off graphics, copyrights, administration, and other website-related costs are expected to be 60,000. Upfront permit registration, licensing, and association fee will cost 290 for the entire fleet. This is going to be what? Capital expenditure or what?
Capital expenditure.
Yeah, they are capital expenditure as well. So which means we are going to have we're going to have licenses and all these others. So it's going to be 60 plus 290,000. It's going to give us how much there?
350,000.
So this one is going to be 350,000. It's also capital expenditure. Right, let's continue with our identification. This is the most important part when you are answering your questions, to identify each and every part that need to be included in your capital budgeting calculation. Right, then let's look at this paragraph. They say on average, each minibus will generate about 1.2 million annually in revenue, and the revenue is expected to remain constant until the end of year 3. So which means the 1.2 million for each, 1.02 million for each minibus will be constant until year 3. Then revenue increase by 4.9 in year 4 and remain at that level for the foreseeable future. So we need to determine the revenue. So we need the revenue for which means our next calculation should be for the revenue. Right, what else do we need? Let's check again from the scenario. After the revenue, we have minibus drivers will be paid an annual salary of 250,000 each, which also include accommodation and out-of-town costs. They might incur. The minibus drivers will be on a fixed 5-year term contract, and each driver will be assigned to his or her own minibus for the duration. So this is going to be the salary for the driver. It's also going to be an expense there. So which means we need an expense for salaries. Right, so what else? Let's check again. What else do we need from the scenario? Then after the salaries for the driver, they say each minibus is expected to travel 50,000 kilometers per annum. The fuel consumption of each minibus is 8.5 liters per 100 kilometers, and this is not expected to change for the life of the minibus. Big Vest already has fuel storage tanks in major depots across the country for the refilling of its logistic business fleet. Fuel is usually kept at sufficient levels, and therefore for the next 5 years, the minibuses will also make use of these depots to refill. Diesel is currently sold at an average price of 22.20 per liter throughout the country. Big Vest buys its diesel at, so which means here we have fuel cost. So in this paragraph, we're going to have fuel cost. So it's going to be the fuel cost. Right, then let's identify any other factor that need to be taken to the capital budgeting calculations. So the next thing that we have is we were here. So they say other operating cost, insurance, repairs and maintenance, road traffic, additional personnel are estimated to be 20% of gross revenue. So here we are going to have other operating cost. So it's going to be other operating cost. Right? What else do we need there? What else are we need from the scenario? Then they say we are here. Assume the South African Revenue Service will allow a wear and tear of 6 years on brand new minibuses. For tax purposes, assume all income and expenses, including other capitalized expenses, are fully taxable and deductible in the same period the income is received or the expense is paid. Unless stated otherwise, ignore working capital investment unless specifically addressed above. So which means we should also apply taxation. I don't know if there's anything that we have left that we need to check there to our capital budgeting from the passage here before we apply the tax. Anyone who can see anything that is still need to go to the table there? So which means everything that we need is now on our table. So which means the next thing that you need to do is to calculate your cash flow before tax. Your cash flow before tax. Once you have your cash flow before tax, then it means you need your taxation. Then after taxation, you have your net cash flows. After your net cash flows, then the next thing that you need is your discounting factor. You need your discounting factor. Then you need your discounted cash flows. After your discounted cash flow, then you need your net present value. So you'll be done with the draft. So which means after you are done with this draft, then it's going to be easy for you now to start to fill in the figures. So we already have, so let's calculate the residual value. So which means we can now do our calculations here. Let's do our calculations. Right, so let's start with calculation 1. We want the residual value. Residual value of the buses. Let's check on the information. What are we going to have there on the residual value of the buses? They say at the end of the 5-year period, these minibuses will be sold at 150,000 each. So which means here we need to determine how many minibuses do these guys purchase. so that we can determine the residual value. So the total cost for the minibus is 230 million, and each minibus is 1,150,000. So here we can get the number of minibuses. Then we multiply by 150,000. So which means it's going to be 230 million divided by 1,150,000 times 150,000. How many minibuses are we going to have there? Total number of
200.
minibuses. Sorry?
200.
So which means we have 200 minibuses times 150. $30 million, am I right?
Yes, you are correct.
Then this one is going to be 30 million. So this is the residual value. So under our residual value, we are going to have 30 million. Then let's do calculation number 2. Our calculation number 2 based on our draft is going to be maintenance plan. We need the maintenance plan. Remember, year 1, year 2, year 3, we don't have maintenance plan. So which means we need a maintenance plan in year 4. So let's see, how do we determine that maintenance plan from our question, from our scenario? So on the maintenance plan, they say each minibus comes with a free 3-year maintenance plan worth 60,000. Then Bybase will have its fleet service for free for the next 3 years or up until the minibus, whichever comes first. Then Bybase will extend the maintenance plan upon expiry on the same terms and cost. The extended maintenance plan is paid upon expiry. So each minibus is going to have a 3-year maintenance plan of 60,000, but the first 3 years are going to be free. So which means we are going to pay the maintenance, the first renewal in year 4. So our maintenance plan is going to be, how much are we going to have as our maintenance plan here? Let's see, how do we put it on? So the first 3 years are free. So which means we have 200 buses times 60,000. How much are we going to have as our maintenance plan for year 4?
12 million.
So it's going to be 12 million. So this is going to be, and on maintenance plan, we should be careful that this is not for every year. That's another thing that we should take note there on maintenance plan. It's not going to be for every year because it's going to be renewed after every 3 years. So which means we only take it into account on year 4. Right, so which means on maintenance plan, we have our 12 million here. Then residual value is after, it's going to be, so this one is an expenditure. Then residual value is income, the 30 million. right? Then what else? The app development is given, the graphic. Then we need to calculate the revenue. We need to calculate the revenue. Let's go to the question and see how do we determine the revenue. Under the revenue, they say on average, each main bus will generate about 1.02 million annually in revenue, and the revenue is expected to remain constant until the end of year 3. Revenue will increase by 4.9% in year 4 and remain at that level for the foreseeable future. So we need to this revenue is for each minibus. So which means we just need to multiply by 20, by 200, sorry. So which means we are going to have our revenue. Our revenue is going to be 1.02 million times what? Times 200. 200 minibuses. How much are we going to have there?
$204 million.
So it's going to be 204 million. Then we need to increase it from year 4. So which means from year 1 until year 3 is going to be 204 million. That is year 1 to 3. Then let's have the revenue for year 4. So it's going to be 204 million times what? It's going to increase by 4.9. So it's going to be times 1.049. How much are we going to have there? Sorry, this is million, sorry. 204 million.
213,996,000.
So which means we need to round it to 214 million. So this is how we answer. So these things, I don't know when people cry about this module. You just need to know what do you want from the scenario. So which means from year 1 to year, so this is our year 1 to year 4. Year 1 to year 3, we need 204. One, two, three. So year 4 is when we have 214. And year 5. Right, so that's there on the revenue. So which means we'll be done with the revenue. So we go to the driver's salaries. Let's check what happened to the driver's salary. They say minibus drivers will be paid an annual salary of 250,000 each, which also include, so each driver is going to have 250,000. So which means we have 200 drivers here. So we just multiply 250 by So this one is going to be 250,000 times 200. We don't need a calculation for this one. So how much are we going to have there?
50,000. 50
So each
million.
driver is going to be paid 50,000.
50 million.
50 million.
Yes.
The total for all the drivers is going to be 50 million.
It's true.
Yeah, it must be
Yes.
50
Yes,
Yeah.
50 million. 50 what?
million. Is it
It's
million or thousand? It must be million because each driver is paid 250,000 per annum. So already it has passed the 50,000. I think 50 million is correct.
Yeah, it's 50 million.
Yes, it's correct.
Yeah, it's correct. So this one is an expense. There is no escalation on these salaries, it's still the same. Right, so we'll be done with the salaries for the drivers. Then we go to fuel cost. We go to fuel cost. On fuel cost, they say each minibus is expected to travel 50 kilometers per annum. The fuel consumption of each minibus is 8.5 liters per 100. So per year, it travels 50,000 kilometers. You can see here, this is where you get your answer. You need to see, okay, let's look at what else is there. So these guys are going to pay 20 per liter. They are going to pay 20 per liter. So you need to determine the fuel consumption of each minibus is 8.5 per liter per 100 kilometers. So which means the fuel cost, you are going to first convert your 50,000 and to the proportion of that per liter. So you come here and say your calculation number 4, fuel consumption. So these guys, they say each minibus is going to travel 50,000, not 50, it's 50,000
50
kilometers. Then you divide by 100, then you multiply by 8.5 per liter, then by the number of minibuses. Then you get the fuel, the total fuel cost. Are we together on this part? Do you guys see how I got this part? Are we together here? So we divide by 100 times 8.5 times 200. Are we together on this calculation for fuel cost?
Yes.
Yes. Is there any other thing that we left? This one is liters, am I right?
I'm still lost on that one.
These are liters, 8.5. We have, what we want here is 50,000 kilometers. And I say 8.5 liter per 100. So this is the 100. Then times 200 buses. Then we still need the cost now times 20. We must also multiply by 20. I think it's full now. Are you still lost, or it's fine now?
I'm still lost. You said 50,000 divided by 100.
Let me go to the scenario so that we understand what exactly is happening there. These guys, they say each minibus is expected to travel 50,000 kilometers per annum. Are we together on that one?
Yes.
It will travel 50,000 kilometers per annum. Then the fuel consumption of each minibus is 8.5 liters per 100 kilometers. So which means for every 100 kilometers in these 50,000, it is going to consume 8.5 liters. So which means for every 100, you get it by dividing by what? By that 100. 50,000 divided by 100, then you get for every 100 that is going to consume 8.5 liters. Then they now go and say, by this already has a fuel, so the fuel cost is going to be 20, and the number of minibuses is remember this one is for each, the number is 200, then times 20 rand.
Okay.
You got it? So the
Yes,
first
now
thing is to get rid of this line. That's the first thing. Is to get rid, so that you can see how many liters does the minibus use. Because here we are calculating the number of liters that are used by each minibus per year.
Okay, it's fine. I got you.
Okay, so let's look at how much are we going to have there. Anyone who got the final figure for the fuel cost?
It's 17 million.
Which is going to be 17 million.
Okay.
Right, so which means this is the fuel cost. Let's do the last one, which is the other operating cost. Right, on the other operating costs, then let's check what they say. You see, this thing, they tell you what to do. There is nothing complicated in these things. The only thing is to know your topics. There is nothing. Make is one of the modules that you can do and understand without even much difficulty. Right, the operating cost is estimated to be 20% of gross revenue. 20% of gross revenue. So in our operating costs, remember our revenue is 204 and 214. So which means we get operating costs there. So we are going to have operating costs, which is 20% of 204 million. And 20% of 214 million. So this is going to be our operating cost. So how much are we going to have in the first one there? The first one is going to be 204 million times 20%.
40,800,000.
40,800,000. So this one is going to be 40,800,000. And this one, the second one?
42,800,000.
42,800,000. Right? Then we'll be done with this part of the calculation. So let's just go and fill in the figures, which is 17 million for fuel cost. So which means our fuel cost is going to be 17 million per year. Then we also need other operating costs. Here we say it's 40,000, 40,800,000, 40,800,000, 40 million. Oh, is this not, this is now 40 what?
42.
42,800,000. So this is 42,800,000. Right? So we'll be done with our cash flows. Is there any cash flow that we still we left out? I think we've done all the cash flow. Ne? Yeah, we've done all the cash flows. So we need our cash flows before tax. We took in, there was no working capital here. Yes, so there is nothing else we left out. Right, we can now do our cash flows. Let's start with the capital expenditure. Our capital expenditure is going to be 230 million plus.
350.
This one is going to be how much? Our capital expenditure is going to be 235 million. Am I right?
You are right.
So we start with here. So here we have two. This one is capital expenditure. Then we need year one. Are they not the same? I think we might be lucky. They are the same. We can just calculate one line until year 3. Yeah, they are almost the same. Is there anything in this column? No. Until year 1, 2, 3, we just need one figure, which is the same. Do we have the figures? Anyone with the first line there? It's just a matter of 204 minus 50 minus 17 minus 4,800.
I get 96,200,000.
96,200,000. Yeah. Is it not the same until here?
It's the same. It's the same for the next year.
So it's going to be 96,200,000. Yeah. So there's then we do this other column. I think these ones are different.
116,200,000.
116, 200,000 on here.
Yes. Year 4.
116. Did you include the 12,000?
Yeah, I subtracted it.
Okay. Right. So it's going to be 100 and what? You say 100 and what?
And 16,200,000.
116.
I get a different one.
How much do you got?
I get 104,200,000.
What's happening? Why are we getting different? Is there any calculation that we? Because here we only have in year 4 we have the maintenance plan, which is which needs to be subtracted. Then we have two.
I'm getting 92,200,000.
Yeah, I also get that if I include the maintenance.
Okay, when are we going to start with this maintenance plan renewal?
Is-
It's in year 4, ne?
Not yet 3.
Let's check what they say, these guys. Maybe we miss something there.
Look at the last line of the maintenance plan, love money.
I want us to go
It
there.
says-
On the
Mhm.
maintenance plan, they say each minibus comes with a free 3-year 180 kilometers maintenance plan worth 60,000. Big Face will have its fleet service for free for the next 3 years or up until the minibus has reached 180, whichever occurs first. Big Base will exchange the maintenance plan upon expiry on the same term and condition. The extended maintenance plan is paid upon expiry. Okay, so which means it's going to be paid on year 3.
Yes.
The extended maintenance plan is paid upon expiry of the original maintenance plan. So our 12,000 must be in year 3 there. Our 12 million must be in year 3. I think there is something wrong there. So which means, let me just do this. So it's going to be affecting this figure as well. So our maintenance plan is in year 3 because it's paid upon expiry. So the 12 million is here, not in year 4. Right, so how much are we now going to have here? I think we need to recalculate this line now.
84,200,000.
84.
84,200,000.
84,200,000. Right, we can do line year 4. I think we don't have anything on top here. We can start here.
It's 104,200,000.
104 million here, 200,000. Then the last one, don't forget the residual value. of 30.
That's 134,200,000.
134,200,000. So these are the cash flows before tax. So which means we need tax now. We need tax. So we need to do the calculation for taxation. We need to do the calculation for taxation. So we need a calculation for taxation. Let's do the calculation for taxation. So our C5 is C6 is going to be taxation calculation. So we have our year 1, year 2, to year 3, year 4, year 5. So we need to check our cash flows. Cash flows before tax. The one that we have, you can also say yes, 0 here. So our cash flows before tax, here we have 96, 200, 84, 200, 104, 200. So we have our cash flows. Year 1, we have 96,200,000. 96,200,000. Then year 3, it's how much in year 3? 84,200,000. You just take your cash flow before tax. Then year 4, 104,200,000. Then year 5, we have 134,200,000. So these are our cash flows. So what do we do with the cash flows? We need to calculate the tax here. What are we going to do with these cash flows?
We need to deduct the allowances.
The capital allowance, né?
Yes.
So this one is a bus, so which means it's going to be a wear and tear. You see, we are going back to tax. They give them 6 million, 6 years, the useful life of the asset for tax purposes. They say it's 6 years. So it's going to be 230 million divided by 6. That is going to be our capital allowance. How much are we going to have there? $38,300,000. Am I right?
Yes.
So our capital allowance is going to be 38,300,000. 38,300,000.
Is it 230 million divided by 6?
Yes.
What about the other threes then?
The other
Because
one?
I get
Sorry?
threes. I get 38,333,333,000.
Or you get
Are we ignoring them?
just ignore those ones. You just round it off.
Okay.
38,300,000. But we get the sense of how we get to our taxable income, because here we want to go to taxable income, so which means we need to deduct the capital allowance. Right, is there anything besides the wear and tear that we can put here beside the wear and tear? Remember, there is a sales value, a residual value. This is the residual value of the buses. What can we derive from this residual value of the buses? There's something that we can get there. Those who are doing tax, I think you guys, we can assist us. What do we need? We sell every time when we do a disposal of an asset. What do we look at every time for tax purposes? Anyone with an idea there? It's tax related, much 100% tax related. Smile, can you try?
Is it not a capital gain there?
Remember, if you check in our business taxation, every time when an asset is disposed, we have to look if there is recoupment or scrapping allowance. Am I right?
Yes, sir.
Yeah, we every time when there is a disposal for tax purposes, then we have to look if there is recoupment or scrapping allowance. So for us to
This one is
determine
a
whether there is
scraping allowance.
yeah. So let's look at, we need to calculate the tax value of the asset. That's the first thing. The tax value of the asset is going to be the cost of the asset, which is 230 million minus capital allowance. Like in this case, we're going to less wear and tear. What is our total wear and tear, which is 38 million 300 times 5, where that is going to be our wear and tear, which is 38,300,000 times 5 years. That is going to be the wear and tear. How much are we going to have there?
$191,500.
So our wear and tear is going to be 190. You say 191?
500,000.
500,000. So this is the wear and tear. So our tax value is how much here? What is going to be the tax value of the asset? So we subtract 230 minus 191, 500. We get our tax value.
We remain with 1 for 1 year. It's 38,500,000.
38,500,000. Right? Then our residual value or selling price. Our selling price is going to be 30 million, am I right? We get 30 million, the residual value of these buses, which means that's what we are going to get. And this is the tax value. So what do we need have? Do we have recoupment or scrapping allowance here?
Scraping allowance.
So we're going to have a scrapping allowance here. And the scrapping allowance is going to decrease our taxable income. So we're going to have a scrapping allowance of 8,500,000 here. Recoupment is going to increase our taxable income. Scrapping allowance will reduce our Scraping allowance is just like a loss. Recoupment is profit. So which means if we get a loss, then it means it is going to assist us to reduce our taxable income. So which means in year 5, we are going to have a scrapping allowance that is going to assist in the reduction of our taxable income. So we're going to deduct this 8,500,000. I don't know if we are together on this part. If there's anyone with a question on this one, remember our FAC, MAC tax, they go together. Those modules are integrated, which means at the end of the day, we need to understand the integration in them. Anyone with a question on this part, on the scraping allowance calculation? So every time if there is a residual value, for tax purposes, you must ensure that you determine whether there is recoupment or scraping allowance. Whenever there is a residual value of the asset at the end of its useful life, you must determine if there is going to be a scraping allowance or a recoupment. Right? Anything else that we need here? Do we have anything else for tax purposes? There is this amount for, there is this amount for, what are we going to do with these alterations to the website will be made by one of the head office full-time IT specialists who is on a fixed annual salary of 740. An external IT consulting company could get paid a once-off 140 for similar work. What do we do with this part for tax purposes? There's going to be a cost saving, am I right? There's going to be a cost saving on this part, so which means we need to take it into account for our tax. Remember, it's going to attract tax benefit. There's going to be a cost saving, which is going to attract tax benefit. So which means we should come here and include it here. Cost saving. And the cost saving is going to have a cost benefit, which is going to be 740,000 minus 140,000. How much are we going to have as our cost saving? It's
600,000.
It's 600,000. Right, so that is going to be a cost saving. Right, so which means the next thing that we need now is our taxable income. That's the next thing that we need. Our taxable income on here, the tax rate is still going to be 600,000. Then in the second column, we just subtract that 38,300. How much are we going to have? $96,200 minus 38,300.
It's 57,900,000.
Then this one is going to be 57,900,000. It must be the same here. right? Then the last one, the next one is now different. We subtract the next one. It's going to be
45 million 900.
45,900,000. Then the second last. 104,200.
It's 65,900,000.
65,900,000. Then the last one is 134 minus
87 million 400,000.
87,400,000. So these are our taxable income. Then we need now the tax. Our tax rate is 27%. So we just multiply everyone by 27%. Here we're going to have 162,000. And the next one is going to be how much?
15,633,000.
15,630,000. Let's just call it 15,600,000. So it's still going to be the same here, né?
Yes.
Yes. Then the fourth column, which is here, the third column,
12,393,000.
12,393,000. What can we do? Can we round it?
Yes, to 12 million 400.
12,400,000. Then this one,
17,793,000.
so 17,800,000. Then the last one,
23,598,000.
23,600,000. So this is our tax. So we go back to our table, here, and fill in these taxes now. I think that's the only calculation that was left. Remember, here we're saying cash flow before tax. So this is our C6. So here we say 162,000. Is it 500? Does it have something? This is 162,000. Then the second one, we say it's going to be what? The second one, 15,600,000. 15,600,000. Then the third one we say is how much? We say it's 12,400,000. Then here the fourth one, 17,800,000. Then here we say 23,600,000. So we need our net cash flows. We need our net cash flows. Here is going, this one is negative, and this one is positive. How much are we going to have here as our net cash flow? $235 is negative. 235 million. How much are we going to have here? On the first one, we're going to have 234. 234,838,000. Then the second one, how much are we going to have there? Are we together? Are we together, you guys? Are we together?
80,600,000.
80.
Yes. 80,600,000.
80,600,000 is the same, like it's the same here, ne?
Yes.
Right. Then the third one. Well, just here. You don't have to stress much. You just come here. Cash flow before tax minus taxation.
71,800,000.
71,800,000. Then this one is
86,400,000.
88 million.
No, 86.
86.
86.
400,000. Then the last one.
110,600.
110,600. Right. So we now have our cash flows. Then we discount using, what is the discounting factor? The work.
16%.
Okay, this is the discounting factor, which is 16%. So we are going to discount using 16%. This one is already in present value. So we need to discount here. I think you guys will now know how to discount. It's 16%, which is 1 divided by 1.16. How much is what is going to be our discounting factor here? 0.862. Am I right? Are we together there? Divided by 1.16. The second one is going to be how much? 0.743. 0.74. Do we still remember how do we calculate this discounting factor?
Yes.
Then the third one is going to be, this is the fastest way of calculating this discounting factor. 0.641. Then the last, the second last, divided by 1.16 is going to be 0.552. Then the last one divided by 1.16 is equal to
0.476.
0.476. So we
Sorry,
need,
last Mark, can you remind me, please? I forgot. I'm not getting all this
you,
amount.
Okay.
Which amount are you dividing by 0?
When you are doing your you want to calculate your discounting factors.
Yes.
When you are calculating your discounting factors, you use your weighted average cost of capital. In our case, it's 16%. So which means you just come on your calculator and say 1/1 divided by, you say 1 over, which is 1 divided by 1.16. It will give you the first discounting factor. Here is determined by what the work that you have, which means if you have 10, which means you are going to say 1 divided by 1.10. If you have 9, 1.1 divided by 1.09, just like that. Then when your figure, the first figure that you have is still on your calculator, you keep on dividing by 1.6, you get the next one. Divide by 1.6, you get the next one, until you are to the last one.
Okay. Thank you.
Okay, so that's so let's have our present values. I think we can share. One can do one, other one 1, 2, 3, 4, 5. So I'm going to do the first one. Then you guys, you can share the remaining one to get the discounted cash flows. I'll do the first one, which is 600,000 times 0.6. I got here 69. Is it million? 69 million 478. And I round it to 69,477,2 69,470,400.
It's 69,477,200.
The first one and the second. 69 million for
77,000.
for
Yeah.
7,000. So it's the same here. 69 million. No, it won't be the same now.
Oh,
The discounting factors are different. So who got the second one?
59,885,800.
69?
59
59 million
885,000.
59 million 800 what?
85
885,000.
800.
No, 885,800.
800, yeah.
So there's an 800 here. Then the third one. Who got the third one?
46,023,800.
46,023,800. Who got the last, the second last?
47 million.
47 million.
692,800.
692,800. Then the last one.
52,645.
62,645,000.
600.
Right? What do we do now? I want us to calculate to add this. So this one is 2,438,000. Right. So which means the next thing for us to get the net present value without using the financial calculator, what are we going to do? We add this and minus this one. So let's get the net present value. The first thing is to add the cash flows. 1, 2, 3, 4, 5 cash flows. Total that we have. So let's have the total for the discounted cash flows.
So we add from year 1 until year 5.
Yes, we add from year 1 until year 5. Those are the present value of the cash flow. So we compare that with the capital that was invested. If the capital that was invested is less than the discounted cash flows, then we have a positive net present value. So how much are we going to have? Let's quickly add so that we can finish this.
I got 275,000.
Straight.
725. 275 million 725,000.
275 million
725,000.
725,000. This
200.
is
200
there's a 200 here.
should be. I don't know. Or maybe my calculator wasn't.
Okay, let's use this one. It's fine. 275, 725. So if this is the total for all the cash flows, discounted cash flow, then we minus this one. So we come here and say minus 234,838,000. And remember, when they mark, we cannot all have the same answer because we have different rounding. You can see someone might be ignoring this 800 whatsoever. So the answer might differ a bit, but not too much. So what is going to be our net present value here? The difference between
40,887.
sorry?
40 million. 40
40.
million 887,000.
40 million 800 and what?
887,000.
808,000.
887.
Right. So this is going to be the net present value of this project. But there's also something that we should look at here in our question. There's something that I saw. Let's quickly look at that. They say using relevant investment appraisal method, determine whether Breakfast company should invest in solar bad project with reference to the minimum investment criteria. Do you notice in our first part that they give us the minimum investment criteria for all the projects? I think it's here. So which means we cannot rely on the net present value only. We should also use the minimum investment criteria for all the projects. Here they say for capital projects, the requirement is that the project should yield a minimum profitability index of 1.05 and have a payback period that is discounted, that is not longer than 5 years. So these are some of the criteria that we should use. So profitability index is just a ratio that compare the present value of the cash flows with the initial investment. So when you are calculating your profitability index, then you come and say present value of cash flow over initial investment. So which means the present value of our cash flow is 275,725,000 over 234 838,000. So that is going to be our profitability index. If the profitability index is less than 1, then it's not worth investing in that project. It must be more than 1 for the project. But obvious, if your net present, if your present value is positive, then it means also your profitability index is going to be more than 1. You can see here with this figure, this is our net present value of cash flow, and this is our initial investment. The present value of the cash flow is greater than the initial investment, which means our profitability index is going to be greater than 1. So what is going to be our profitability index here? 725,000 divided by
1.17.
sorry,
1.17.
1.17. That is our profitability index. Ne? So if this is our profitability index, then as compared to what these guys say is the minimum criteria. So if we use the profitability index, then it means they should invest in the project. Let's check what was the because they say a project should yield a minimum profitability index of 1.05 and have a payback period that is longer than that is not longer than 5. So using the profitability index here, it means they can invest in the project because we have 1.17 as compared to 1.05. Right, so which means the next thing again is to also to check the payback period, which is your, how do we determine the payback period? Do we still have the idea for the pay? So which means the next thing is to determine the payback period. How do we go with the payback period? It means we come here. This is our investment. Then they say that it must be the discounted. Then we minus this until this is finished. Then when this one is finished, then that's the payback period. So let's see how long does it take to finish off this amount. Let's do it even here. I want us to do it here. Right, so let's start with here. We subtract this one. How much are we going to be left with if we subtract 69,747,000?
165,361,000.
So here we're going to have 165,300,000 what?
61,000.
361,000. Then let's subtract this one from here again and see in year 2 how much are we going to be left with. So it's going to be 165,361,000 minus 59,885,800. So here we're going to have 105,475,200. Then in here, how much are we going to have? We subtract again 46. Sorry?
59,451. 59,451,000.
59,451,000.
400.
451,400,
Yes.
right? So this is year 1, year 2, year 3. So let's go to year 4 and subtract 47 from 59.
11,758. 600.
11,000, 11 million,
750. Oh, million, sorry. 758
thousand,
and then 600.
600. Do you see
Yes.
that in year 4, 5, when we go to year 5, we're no more going to be able to subtract this one. So what are we going to, so which means we have 1, 2, 3, 4 years. So it's going to be 4 years plus 11,758,600 over 52,645,600. So let's clear the fraction and see how many months are we going to have there. Divided by 52,645,600 times 2. How much did you guys got?
0.
So our payback is going to be 4 years,
Three months.
2.6 what? Months, 2.7. When you have that 0.
Yes.
If you want to convert it to months, you multiply by 12. When you have 0 point whatsoever here, when you divide here, to convert it to months, you multiply by 12. But if you want to leave it, then it means you give your answer like 4.2, 4.2, 4. You give it in a decimal form like 4 point something. But if you want to convert it to months, it means that 0 point you get, you multiply by 12. Then you are going to have the months. So which means the payback is 4 years, 2.7 months. So if this is the payback, then it means these guys have to invest in this project because the profitability index is 1.17 as compared to 1.05, and the payback must be less than 5 years. So it's less than 5 years here. So they can invest in the project. The net present value is positive. So these guys can invest into the project. So based on their investment criteria selection, they want us to do the payback and the profitability index. Right? I think that's how we, and when you are doing this, that's why you see most of the time, these guys, they are clever. They always plagiarize people because they know there is no way you can have the same figures because of this rounding and other stuff. So when they mark your answer here, they will not penalize you for your rounding. Like you can see here, somebody might just ignore these last figures. So they won't penalize you for that. So which means what they look at is the structure that you are you on the right track in your answering. So there is no way people can have the same answer here. There is no way. If people have the same answer, it means they are working together. Right? I think that's the end of this long question. if there is anyone with a question before we close the class, then we can close the class. I would ask you guys to, let me just check the question again. I want you guys to look at this. These are small answers. You can look at them. A and C. These are part of our capital budgeting. So when you are looking at A, you go to our notes. Remember, we have independent projects, divisible project, we have independent projects, and we have mutually exclusive project. If you go to the notes that we have, you can tell which projects are divisible, can be divisible, which one are independent, and which one are mutually exclusive in that scenario. The moment you understand these terms, then you will be able to see which one is going to be divisible and which one is going to be independent and which one is going to be mutually exclusive. Then C is just what we used to do. These are the non-financial factors they should look at on C. So in our next, after we do business valuation, which is our next class, I think we should be able to answer all these questions, the remaining questions. After we do business valuation, we should be able to answer the remaining questions, which means on Wednesday we'll do business valuation. Then on weekend, Saturday, then we'll finish off these questions. We're doing revision. There will be no enough time for the revision. So this is how we're doing it. After the topic, we do a question based on that topic on that particular day. Then the next weekend, then we go to a revision question. So our next topic is going to be business valuation. Then we'll be able now to answer D, E, F, and G. I think we should be able to answer them after that business valuation. Unless if there's anyone with a question, then we can close the class for today. Any question?
I would like to,
Yes.
yeah, I would like to ask something.
Yeah.
Are we not supposed to separate depreciation for the from the cash flows for tax purposes?
Okay, you mean the depreciation?
Yeah, for tax purposes.
Okay, based on our question, let me just go to the question and see. What was the criteria for depreciation here? Okay, you know, when it comes to depreciation, remember we say depreciation is a non-cash item. So what it means when they say depreciation is a non-cash item, when we are doing a decision, we don't take into account the depreciation expense. If, like what you are saying, if when we are calculating our tax, if the cash flows that we have were cash flows after depreciation, it means we were going to add back the depreciation and subtract the wear and tear. But in our case, we have cash flows before depreciation. So which means there is nothing that we are going to adjust there. But if the question has already given you the cash flows after depreciation, when you calculate your tax, it means you add back that depreciation that was deducted and then apply the wear and tear. That's basically how you treat depreciation, because remember, depreciation is a non-cash item. So on cash flows, it should not affect your cash flows. If it has already been deducted to arrive at the cash flow, then you need to add it back so that you can have the cash flows excluding non-cash items. But if the depreciation is not already there, then you don't need to worry yourself. If there is no depreciation that has been deducted on your cash flow, then there is no need for you to worry about depreciation. I don't know if I am on the right target there.
Yeah, I can hear what you say, but I also want to know, is those tax allowances, are they cash items?
It's for tax purposes, that one. Remember, there's a difference between this accounting and tax. So those you guys, when you are doing your, there must be a different here between accounting and tax. If you can go back to your text, you remember there are those questions. There's that question that we are provided with profit, accounting profit. You see, these things, they are related. We are provided with accounting profit. And for tax purposes, what do we do with depreciation? We eliminate, we remove the accounting. For us to be able to arrive at the taxable income, we need to get rid of the depreciation that was already taken out, and then apply the what? The tax rule. Those who are doing tax, I think we did a question like that. Even you guys, when you are doing your FAC, you can see this thing. So there is a difference here between accounting profit and tax. So which means those tax, those capital allowances, we want to arrive at taxable income. That's why we apply them there, so that we can tax that income. I don't know if it is getting in on you, on you, because if you check here, depreciation is accounting. So we need to add it here so that we can apply the tax rule to arrive at the taxable income.
Okay.
Are you there? Are you okay? It's not okay.
Yeah, I heard it.
Yeah?
Yeah, I heard it that depreciation should be added back. It was if it was deducted, but if it wasn't deducted, and then we should not consider it.
Yeah, if it is not already been deducted from your cash flows, then you don't have to mind about it. But if the question say, let's say they give you cash flow after depreciation, they can say your cash flows after depreciation. It means for you, for this capital budgeting, that depreciation is a non-cash flow. Then you need to add it back. You have to add it back. Even for your calculation for tax, you need to add it back and subtract the capital allowance. This is why we do it even in tax. If you are provided with profit after depreciation in accounting, then you are required to calculate the taxable income. It means you get rid of the depreciation, because depreciation is for accounting purposes. Then you now apply the Income Tax Act rule, which means you are now going to less the capital allowance there. So tax, MAC, FAC, they are integrated. You guys, you will see when you do your further module for this, you will see that you are going to write a paper that is one paper integrated for FAC checks, especially normally it will be FAC checks, MAC, and auditing. It will be one paper that is integrated, which means these modules are integrated. When you are doing this other, you must also think of what you did in the other one. It is also going to help you. Right? I don't know if we are together. You can also, if you want to, if you have your MAC study guide, which I would encourage everyone to have for 2602, try to check some of the questions from 2602, how they were done. You will understand it very well. Okay, any other question before we close the class so that we can enjoy our remaining hours of the weekend?
So that we can go and drink our beers.
Ah, you guys, you don't have that time. You must be busy. There is no time for that now. It's okay.
At least for refreshing.
If you can,